Singapore has revised its headline inflation rate upwards to as much as 5.5% for this year. Now, that's about 2 percentage points higher from an earlier forecast in January. In a bid to slow down inflation, the country is tightening its monetary policy for the third time in 6 months. Chua Tian Tian with this report.
Grocery and electricity bills are set to keep rising this year. Singapore's central bank says the surging prices have weakened consumer and business confidence. The war in Ukraine and disruptions to global supply chains have been pushing up prices of energy and commodity imports, and that's driving up inflation in the city-state to its highest level in nearly a decade. MAS is now raising its forecast for core inflation, which excludes the volatile transport and housing costs. It's projected to come in at between 2.5 and 3.5%, half a percentage point higher than the 2 to 3% forecast in January. The figure is expected to be even higher if it includes transport and accommodation. Forecast for headline inflation has been revised upwards to up to 5.5%. That's from the previous range of up to 3.5%, and it comes amid higher COE premiums and petrol prices. Accommodation costs are also higher, as the backlog of delayed residential projects will take time to complete to meet consumers' demand. To slow the pace of inflation and help keep prices stable, the central bank is tightening its monetary policy in 2 ways. One, by recentering the midpoint of the policy band, the Sing dollar nominal effective exchange rate at the prevailing level. And two, by increasing the slope of its policy band. This will allow the currency to appreciate faster. A stronger Sing dollar will make imports relatively cheaper. This, in turn, will help to bolster domestic prices.
The bigger threat at the moment is external inflation. I think because of the quantum of the increase in global oil prices, we are still going to see it, but that sort of appreciation of the Sing dollar helps to moderate at least a bit of the increase in the prices.
Fresh shocks like the impact of China's COVID lockdowns on global commodity prices are also putting pressure on domestic costs. But although a stronger Sing dollar will make local exports less competitive in the global market, analysts don't see this as an urgent issue for now.
Tourism-dependent industry may also be affected with this appreciation, as the prices of goods and services from Singapore will be relatively more expensive when compared to other options that they have in mind. So vacation in Singapore would be more expensive. In terms of magnitude, I think it's not a big concern. And in particular, a lot of nations are coming out of the pandemic, and a lot of nations are opening up the frontier and border. So there's increasing demand for people just to go out and travel.
MAS says it will continue to monitor developments in the external environment and their impact on the Singapore economy.
The central bank has tightened its monetary policy 8 times over the past 12 years. Now, such moves are made to counter inflation. The MAS had adjusted 2 out of 3 levers before. The last time was in April of 2010, following a strong recovery from the economic downturn the previous year. Core inflation was at 1.5% that year. Now, the strong pace of growth led to another tightening in October of 2010. In the first quarter of 2012, Singapore's economy expanded as investor sentiment picked up. The positive outlook came after the Eurozone debt crisis in November of 2011, which saw a weakening of the Sing dollar. Expecting sustained external inflationary pressures, the policy was revised upwards, and core inflation stood at 2.5%. Then in 2018, ongoing trade tensions between the United States and China, that impacted trade significantly. With Singapore's labour market improving, it also put upward pressures on inflation. These prompted another policy band adjustment. In October, it allowed for a modest and gradual appreciation of the Sing dollar to help stabilise those prices. 2018's core inflation stood at 1.7%. Now, more than a year into the pandemic, vaccines proved effective and vaccination rates rose globally. And as Singapore transitioned to an endemic stage, inflation was forecast to rise. Core inflation in 2021 stood at 0.9%. In an off-cycle announcement this January, MAS again tightened its monetary policy. It came as economic activities picked up, which fueled global demand while supply bottlenecks persisted. January's core inflation rose to 2.4%. Now, the central bank's move today is the third that it's made in 6 months. And it was made amid the war in Ukraine and disruptions to global supply chains. Core inflation is expected to range between 2.5% and 3.5%.